the numbers and underline. So we're going to underline over here. So there we have that. Not sure we need decimals actually, but we'll keep them there. All right, and then we're going to have the total contribution margin for the new proposal. So we'll multiply that out. It's going to be the 650 times the 135 tab. It's going to equal the 92 units we're going to produce times the contribution margin 108. If we add the total up, then the contribution margin for both of them, the total contribution margin for proposal 1, is going to be for A and B, the 97,686. Then we're going to compare that to the total contribution margin that we currently ran up here. So I'm going to say, let's look at the contribution margin here and compare the totals out. So we're going to say this had been 59,400. Therefore, if we look at the change or the difference, which of course is a subtraction problem, we're going to take the prior contribution margin minus the new contribution margin minus the prior contribution margin. We get the 38,286. I'm going to go ahead and underline this one by going to the Home tab, Font Group, and Underline. And then we're going to have to include to that the fixed cost, the added fixed cost. And the data up here said that was 13.5. So 13.5 added fixed cost for this new proposal. 13.5 that we have, we're going to go ahead and underline that. We're going to go to the Home tab. We're going to go to the Underline, and there we have that. And that'll give us the change in operating income or loss. So I'm going to tab over here. We're going to say that equals the 38,286 minus the 13.5, and it is a positive number. Therefore, the conclusion is to make the change. We want to do this. Yes, it's a go to do that. And you might be asking, why don't we have the fixed cost for the old scenario? Why don't we have fixed costs up here for the prior scenario? And notice the reason is that doesn't change our analysis. The fixed costs are fixed. It doesn't matter what is going to happen to them because they're going to be fixed. But down here, if we said that we added this other information, some of the fixed costs would actually increase. We would have to pay more on that portion as well. That's why this portion is relevant. The fixed cost that would be in either scenario, not relevant in this scenario. Next thing we're going to do, alternative 2, another proposal. So we're going to do alternative 1. Then the question is, do we want to add to that? A company may increase product A maximum sales by 700 by spending $12,500 per month in advertising. Uh-oh, the marketing department is here asking for money for advertising. And they, of course, say that if they increase the advertising, you give them $12,500, then they can increase the sales for product A. Product A having a higher contribution margin, as well as a higher contribution margin per machine hour, and therefore that could possibly increase our overall revenue. So let's do the analysis on that and see what we have there. So we've got, we're going to start off again with the hours required to produce the maximum units. So we're going to have to recalculate this because we did calculate the hours required to produce the prior maximum units, which was the 650 here. But now we're going to have to produce the hours to produce the new maximum number of units, and that maximum now is going to be that 700. So we're going to take the 700 and we're going to multiply it times the 0.4 because it takes 0.4 per unit, 0.4 machine hours. Therefore, we have the 280 here. So 280 units, and that will maximize product A, meaning 280 machine hours. We're applying all the machine hours we can to get to that maximum sales number that we think we can sell according to the marketing department. So now we're going to say that the added hours, remember that we have capacity of 352. So if we're spending 280 on product A, then we're taking the 352 minus that 280 means that we're going to be spending 72 spillover into product B, and that total the 352 that we have available at capacity. And then we're going to take the machine hours per unit. I'm just going to say this equals this one here, machine hours per unit, and that is going to be the same numbers as well. This is going to equal the 0.4 and the 1. And I'm going to format paint that. I'm going to highlight these. I'm going to go to the Home tab. We're going to paintbrush that. We're going to bring that down and paintbrush. We're going to add decimals and underline there. So we're going to divide this out. That'll give us the units that we're going to produce. So we got the 280 hours divided by the 0.4 is going to bring us that 700. That's that 700. We just basically recalculated it. Then we got the 72 divided by 1, and of course that's just the 72, so we're going to be producing 700 units of product A like we planned to do to maximize that out, and therefore we'll be producing 72 units of product B. We're going to multiply that times the contribution margin. So this equals the contribution margin, which we have up here somewhere. Contribution margin per unit. And I'm going to say this equals the contribution margin here. And this equals the contribution margin there. And I'm not going to add the decimals this time because we really didn't need that. And I'm going to underline it though. I'm going to go to the Home tab, Font Group, and underline. And remember, the contribution margin per unit, that's how much we walk away with after each unit sales after variable cost, not including the fixed cost. We're going to multiply that out for the total contribution margin on the new proposal. So we'll say tab, this equals the 700 times the contribution margin 135 gives us the 94.5. This is going to equal the 72 times the contribution margin per unit 108 tab. And then we're going to add this up. This equals the 94.5 contribution margin for product A plus 7776 contribution margin product B is the 102,276. We're going to compare that to the total contribution margin on the new proposal 1, which we decided to do last time, which is this one here, and compare that and see if it increases or decreases. And I'm just going to pull that number down. We said that we had this one, that 97,686. We're not including, notice, the fixed cost down here because we're already accepted proposal 1. The only thing that's going to differ between proposal 1 and proposal 2 is due to the contribution margin differences. All right, so we're going to, there's the difference. We're going to say that that's going to be the change in the contribution margin. So I'm going to say that's the change between proposal 1 and proposal 2 in the contribution margin. We'll subtract that out. So I'm going to say this is what would happen under the new proposal minus what happened under the old new proposal that we're going to accept. And then I'm going to underline this, go into the Home tab, Font, and Underline. And then we have to add to that the fixed costs. Again, there's some added fixed costs with this proposal because we got the advertising department wants money. So we're going to say they're asking for 12.5 in order to make this happen. And if we compare that out under this analysis, we're going to say that we have the increase that would happen under this analysis due to and it's a logical proposal, due to the fact that we're going to spend to produce more of product A, we're going to get an increase in the contribution margin, 4,590, but it's costing us 12,500 on fixed costs for advertising. Therefore, we actually have a negative change under that proposal, and therefore we're going to say the conclusion would be no-go, or no-go. And so, so possibly if they could make that happen for $4,000 maybe, or something like that. So those are going to be the analysis.